Good evening. Ira Epstein of Linn Associates with your evening financial market wrap-up. And this is for Tuesday, January 12th, 2021, 5:45 p.m. Central Time. Well, you can see flat stock market opening to begin with. Metals higher, but they were down too much at 12:30 compared to where they were trading late in the day, and that's why they've jumped. It's not that a new event happened overnight. The dollar down. We're looking at bonds and notes up. So what's the theme? Well, the market theme right now is a bit of fear. Tomorrow we head into the day where the House is going to vote on another round of impeachment. That should get very interesting. Mitch McConnell is quoted on many news wires as saying it's time to get rid of Trump. That's a real change of face, isn't it? And I don't know which way he'd vote. I saw a law professor today from Harvard on, I think it was CNBC, but I can't say that I'm sure. It might have been Bloomberg also. And I watched the full interview, and it's interesting. The president could avoid impeachment if he were to resign, apparently, but he could also do this and stay as president until it's brought to the Senate for a vote or when they return on January 19th. And resign that day. Pence would take over for 24 hours, and the president, from the sounds of it, and I'm not a law, believe me, I'm not a law expert. I don't want to be one. I appreciate what he did. If that is the case, then there wouldn't have to be an impeachment. He's out of office and he didn't finish what he did. He resigned. That would allow him to run again. But from the sounds of it, everybody at this point is just plain fed up with what the president has caused. Between the lines, you're reading that they're blaming him for the loss in Georgia of the 2 seats in the Senate, and of course the riot that occurred. Not a good last series of days for the president, but I'm not about politics here. I'm about what the market's thinking. And what the market is thinking is, gee, we're going to go through this again. That weighs on these markets a little bit. I think that's the thought process that is there. We get a lot more economic data tomorrow, the next 2 days, in fact, and the market seems to be getting its feet under it one more time, which I think is interesting there. When you take a look at the S&P 500 index, you can see how this market has made a run, and it's still continuing to run. And while it's down for the first 2 days of the week, it's only down 0.62%. That's not very much, considering all the gains that it has made. When you look at the chart action here, you can see how it's struggling. It seems to come up, roll back, but then it seems to come up and make new highs again. The pattern is not a trend pattern tonight. What you have on the daily chart is a higher high and a lower low. The smartest thing you can do on markets, if you want to learn to be a trader, is throw the name off the chart. And if you learn to do that and you realize the chart you're looking at knows an idea of the pattern, that will serve you probably better. You still have to understand monetary risk because you have to know what the points are worth if you're going to use money as a filter, as I do on many trades. But it's definitely something you want to look at. So I look at the market. I see no trend on the swing line. The market is trading over the red line, the 18-day average, so the bias of the market is up. It's clear to me that each time the market attacks that number, it has found support. The Bollinger Band continues to act as a resistance point in the market. The upper band is your resistance. The market has hit it, backed away. It didn't hit it today for the first time in 1, 2, 3, 4 sessions. So that's interesting. It's not what I call a gorilla glue trade where it just locks in and stays on that band. But while it didn't hit it today, it didn't hit it back here, and it hit it a bunch of successive days leading up to that. So don't get carried away with that. This market still has buying power in it, and you have an embedded reading. So let's make sure the reading's embedded. You don't include tonight's trade because we don't know how Wednesday's going to finish up. So you go to Tuesday, both numbers over 80. You go to Monday, both over 80, and you go to Friday, both over 80. You have an embedded reading. What does that mean? It means that until the red line closes back under 80, Pullbacks in the market, as you're getting them, are likely to be bought by the pros looking for the market to come back up to that resistance point of the upper Bollinger Band. Lose the reading and it means that momentum is leaving the market, and it often leaves it before price. And that could lead to a pullback to the 18-day average of closes. You have nothing like that in the NASDAQ. In the NASDAQ, you have a market that got overbought, and what the market's doing is breaking down, trying to get rid of that overbought condition. The way that I teach charting, any reading over 70 is overbought. Therefore, it needs to get both numbers in the slow stochastic under it. It hasn't done it. Instead, what the market keeps doing is, like the Dow, it keeps finding its support at this 18-day average of close. It's keeping the bias basically to the upside, and it is not in a trend. It has a lower low and a higher high. When we took out right here, the high of an outside day down, that set up the test of the upper Bollinger Band, which you've done, and it just plain ran out of momentum at that point and has pulled back. When I look at the Dow Jones, you have an embedded reading. I won't go each day to prove it. Trust me, you're fully embedded. And unlike the other indices, you have the pattern of higher low, higher high. I think the pros are aggressive in this. Now, it gets even more bullish should the 18-day average of closes get up and over 306.38, but that's 200 points away. That isn't going to happen 1, 2, 3. I just said it would get more bullish. In the red line, you'd have to close under, let's call it 79 for me to be comfortable that you've lost the momentum. Until then, I think the market will find support on these breaks with prices looking to head back to the upper Bollinger Band. The Russell is the same. It's an embedded reading now. Higher lows, higher highs. Something else here. This is the Gorilla Glue trade. It's a market that day after day just keeps hitting that upper Bollinger Band. It doesn't get away from it on the top side very much or the bottom. That's a very bullish situation. It's often accompanied by an embedded reading. It creates the embedded reading, and that's where you're at. For the market to pull back, I need to have that red line close back under 80. In the VIX cash, you're just caught in these bands of the Bollinger Band. I know that you popped out of them twice, and I know the end result both times. You went back right away to the 18-day average. There was no life to the pop out of that. Same thing's going on again. Now, you do have resistance over the market of the 100-day average in green and the upper Bollinger Band, but you're not in a trend. So this isn't telling me a story to give me an edge as to what the traders think might happen in the stock indices. In the T-bond market, I told you we had 5 days down coming in. Was it 4 or 5? I think it was 4. 1, 2, 3, 4. The odds don't favor that you get 5 in a row down. 6 is really pushing it. So I'm looking for a bounce coming into today, and late in the day, it was real late, you had that bounce. Now, it's interesting. We had a $38 billion auction today of U.S. Treasury debt, and it was well bid. If you look at the ratio and how it was done, the dealers only ended up owning about 20%. 80% went out to the people that wanted to buy it. And maybe this 113 level is an area where you've dragged out people that say, okay, we'll buy it, and they finally found the buying zone rather than people buying out of fear. Remember when we were down to 0.65? So I'm just giving you an idea. Do I think it's going to change the curve yield? No. I think the higher rates are going to go in the background, but I think the front just gets stuck here. This is the 10-year note. You can see that you've had 1, 2, 3, 4, 5 lower closes. I was doing all that talk about the 10 too, but you can also see where it finished the day up, right knocking on the door. Last trades of the day were knocking, in fact, at that Bollinger Band, and tonight you popped right back over it. The higher you go, the lower the yield. So the market was searching for where the auction would go off well. It found it, and you're getting a little bounce. That's the way I'm interpreting what happened. In the dollar index, I look at how the market's in an overall downtrend. We had this bounce that took the market away from that trend. It's not in a trend at all. It's got a lower low, higher high, and it's corrected up to the Bollinger Band and ran into a brick wall. So often I'll say that I think these pros take money off the table on the first challenge of a band. Well, if you got up there at 90.67 and you finished the day out today at 90.06, that's a pretty good move in the market, and I'm sure that they're pleased with that. But we need to see a trend, and we don't have one just yet. Eurocurrency is the same thing. You went from the upper band to the lower in a sideways action. So the market has stepped out of its uptrend, but on the weekly charts, it's still a friendly chart. British pound, this is the market that you got to learn money stops. Here's the market in what I'll call a selling configuration, but your stop would have to be way up, and it would be a certain amount of money that I have a filter on regular trades using monetary risk. Otherwise, you're just saying, I'm taking every buy and sell signal. It's a hell of a way to go broke. The real world is, teaching is one thing, trading is another. And you have to also take in what you can afford. I don't care how wealthy you are. All you're doing is adding, instead of trading 5 contracts, you're trading 50 contracts, right? It's the same dollar risk per contract. And I put in filters. Take the charting course and you learn what those filters are and why I did them. So what's really happened now is the market's come up, making a run at the upper Bollinger Band. Now it's not trending again. You have a lower low, higher high scenario. Bitcoin. It's funny, I saw some comments on the YouTube page, and the gentleman that wrote it, I'm agreeing. I'm still looking to see if can you make a run to the lower 18-day average of closes. Why? Because when you lose an embedded reading, often the market makes a run towards the closest moving average, the main one, and this is the main one right here. The others are below the market. So we'll see if it does it or not. What's the bias though? Regardless, you're not bearish. You're still looking for the market to hold because you're over that 18-day average. Doesn't mean you're not getting some short sellers in there. I think you are and have. This is the differential between Brent and WTI crude, and it looks like you got a bit too high at 372, and all of a sudden you're in a pullback. But since we were down here towards the 180 level, the market is basically saying that's too cheap of a differential. And once it got over that, away it's moved to the upside. This has told you what? You've got to be careful here. Brent is stronger than WTI, and that's a filter on it that should help you with your trading if you're looking to be a buyer or seller of the different energies. In the crude, the WTI, we have that gorilla glue trade. Every day you're hitting that number, and it's pulled and developed an embedded reading. Important to recognize. March WTI crude, up and away to the upside. Heating oil, up and away. Right now with an embedded reading, another set of gorilla glue trades. When you get that, you don't get the break you want in the market to get long. That's to be expected. In the nat gas, overbought, has gone from a lower band to an upper band in a 2-week period. In the process, it did develop an uptrend, and if you didn't take your money off the table today, well, you're not looking good right now because it gave you that one opportunity, and we talk about that. In the grain markets, we went limit up in corn today. 43 cents higher or so in the soybeans, wheat up sharply. This was the end of the year USDA report for world stocks and U.S. stocks. And it just shows U.S. grains are in a very, very tight situation. That is a bit bearish on feed, the animals. And you saw the cattle market drop down because feed prices are going up, and the farmers are going to look for acreage galore this year to see where they can put things. We did a lot of talking about that today because that was where the action was. You don't get a limit up in corn or a limit down very often, but when you get them, you pay attention. There's reasons that it's going on. Going through these reports, not the most fun for a lot of traders, but the market's been bullish and it just got more bullish news. We talk about this, we talk about the metal markets, we talk about the stock indices, all through our charting software and our handheld platforms as well. So you get to see that, and we write all day long reports. So I know a lot of people, I happen to love doing videos. My cohorts there, they love writing, and that's what they do when they do oral presentation. We'd like you to try it. How do you get it? It's free. Just give us a call, no credit cards involved, or you can go to our website, under free offers. Sign up for it there. We'll put that and the other things you sign up for in your hand. I'm Ira Epstein. Have a good day. It's going to be impeachment day tomorrow, so you know what they're going to talk about all day. And remember, we're starting to see earnings reports come out, so that'll impact the spider ETFs in the first thing in the morning, and of course with the stock indices themselves. Have a great night.